Hello students. Today I am going to start with a very important chapter, that is amalgamation, absorption and external reconstruction. This chapter is usually a nightmare for the students, but I will make it very easy and interesting for you. Today I will tell you about the meaning of amalgamation, absorption and external reconstruction, the meaning of purchase consideration, and the different methods of calculating purchase consideration. Let me proceed further now. Generally, these three terms, amalgamation, absorption, and external reconstruction, are used together. However, there is difference between these three terms. So, let us first of all see the meaning of each one of these terms one after the other. First, let us see what is meant by amalgamation. When two or more existing companies combine together to form a new company, it is called amalgamation. Let me repeat again. You can just have a look at the screen. When two or more existing companies, when they combine together and when they form a new company, that is called amalgamation. So what is required in case of amalgamation is that at least two or more companies, existing companies should be there, and these two existing companies should get liquidated, and they should in turn form a new company. Okay, so let me give you a very simple example to understand what is meant by amalgamation. Let us say that there is a company by name X Limited and there is another company by name Y Limited. So when this X Limited and Y Limited get liquidated and when they form a new company called as XY Limited, this is amalgamation. I hope I'm making it clear to you. So there are two existing companies, namely X Limited and Y Limited. When these two existing companies get liquidated and when they form a new company called XY Limited, that is called as amalgamation. So I hope you are clear with the meaning of amalgamation, where the formation of a new company is essential. Okay, here the combining companies are liquidated. Okay, what is happening to the combining companies? They are getting liquidated and a new company is started, and a new company is started to take over their businesses, to take over the business of the liquidated companies. This is what is the meaning of amalgamation. Now, let us proceed with the meaning of absorption. What is absorption? Just see the screen here. When one existing company takes over the business of one or more existing companies. I'll repeat. When one existing company takes over the business of one or more existing companies, that is called absorption. Okay. So one existing company absorbs, it takes over the business of one or more existing companies. It is called absorption. It is given the companies whose business is taken over is liquidated. The company whose business is taken over, that company gets liquidated. And what is very, very important in case of absorption is that no new company is formed. No new company is formed. I told you in case of amalgamation, a new company is formed, isn't it? Whereas in case of absorption, no new company is formed. So, what is absorption? When one existing company takes over the business of one or more existing companies, that is called absorption. To give you a very simple example, if Y Limited, if there is a company called Y Limited, which is an existing company, this takes over the business of X Limited. So Y Limited takes over the business of X Limited. In this case, this is called absorption. So what will happen? The business of X Limited will get liquidated and Y Limited will continue to function. Okay, so this is what is exactly meant by absorption. So now let us see what is meant by external reconstruction. So I've told you regarding what is amalgamation, I've told you regarding what is absorption, and let us now see what is meant by external reconstruction. When an existing company is liquidated, when an existing company is liquidated and a new company is formed, and a new company new company is formed with the same shareholders. This is what is very, very important in case of external reconstruction. Okay, when an existing company is liquidated and a new company is formed with the same shareholders to take over its business, then it is called external reconstruction. So, what happens in external reconstruction? The existing company is getting liquidated and a new company is being formed. Okay, a new company is being formed, but the new company is formed with the same shareholders who were there in the earlier company, in the existing company, which was liquidated. Okay, so such an situation is only called as external reconstruction. So, for example, if there is a company X Limited, and if this X Limited is liquidated, and if a new company called Y Limited is formed with the same set of shareholders, then that will be called as external reconstruction. And what is important in case of external reconstruction is that a new company has to be formed. Formation of a new company is needed. Okay, so remember, both in case of amalgamation as well as in external reconstruction, a new company has to be formed. Only in case of absorption, no new company is formed. So this is a very important point which you have to keep in mind. And when you say external reconstruction, it is stated that sick companies with accumulated losses, which run in losses continuously, such companies usually prefer external reconstruction. See, companies with accumulated losses usually prefer external reconstruction. So I hope you are clear with what is meant by amalgamation, absorption, and external reconstruction now. The next important concept about which you have to know in this chapter is purchase consideration. So let us see what is meant by purchase consideration now. Purchase consideration is the agreed amount. It is the agreed amount which the transferee company, that is the purchasing company, pays to the transferor company in exchange of the ownership of the transferor company. So I'll read it once again. Purchase consideration is the agreed amount which the transferee company, that is the purchasing company, pays to the transferor company, that is the vendor company, in exchange of the ownership of the transferor company. So you have to be very clear with what is meant by transferee company, what is meant by transferor company, and so on, right? So transferee company and purchasing company are one and the same. To be very simple, the purchasing company is called as the transferee company, and the vendor company or the selling company is called as the transferor company. When you take the question, what is purchase consideration? It is the consideration payable by the purchasing company to the vendor company, to the selling company. So, what is purchase consideration? It is a consideration payable by the purchasing company to the company which is the selling company or vendor company. So you must have studied in law earlier, isn't it? No consideration, no contract. Consideration is something in return. That something in return which is payable by the purchasing company to the selling company, that is only called as purchase consideration. And this purchase consideration may be in the form of cash. Okay, it may be in the form of cash, or it may be in the form of shares, or it may be in the form of any other asset as agreed between both the companies. What do you mean by both the companies here? The transferor company and the transferee company. So this is what is the meaning of purchase consideration. As I told you, to give the very simple meaning, purchase consideration is the consideration payable by the purchasing company to the vendor company. Now, let us proceed with the various methods of calculating purchase consideration. This is a very, very important topic in this chapter. Methods of calculating purchase consideration. Very often in the examination, you will get a theory question: what is meant by purchase consideration, and explain the various methods of calculating purchase consideration. So, you have to know about the various methods of calculating purchase consideration very clearly. So, let me proceed with the methods now. Okay, the amount of purchase consideration may be computed, may be calculated under any of the following four methods. So we have four different methods for calculating purchase consideration. And what are they? The first one is lump sum method. The next one we have is net asset method or net worth method. The third one we have is net payment method. And the fourth one we have is intrinsic value method. So what are the four methods we have? Number one, lump sum method. Number two, net asset method or net worth method. Number three, net payment method. Number four, intrinsic value method. So it must be remember that in all the above four methods, we have four methods here, isn't it? In all the above four methods, as per the provisions of AS 14, as per the provisions of AS 14, you should know what is meant by AS 14. AS 14 stands for Accounting Standards 14, which deals with amalgamation. Okay, so as per the provisions of AS 14, consideration payable to shareholders alone should be shown. When you say purchase consideration, as per the provisions of AS 14, consideration payable to shareholders alone should be shown. So, what do you mean by this? Consideration payable to shareholders alone should be shown. Amount payable to other claimants. Okay, other those who claim, they are only called as claimants. Amounts payable to other claimants like debenture holders, creditors, etc., should not form part of purchase consideration. They should not form part of purchase price. So let me repeat once again. Whatever may be the method you follow, as per all these four methods, as it is given in the provisions of AS 14, consideration payable to the shareholders alone should be shown as purchase consideration. Amount payable to other claimants like debenture holders, creditors, etc., should not form part of the purchase price, that is purchase consideration. Okay. Now, let us see in detail regarding each one of these four methods. The first one we have is lump sum method. So, what's the first method we have? The first method we have here is the lump sum method. So, in the lump sum method, as the name itself tells you very clearly, whatever is the purchase consideration, that lump sum amount will be very clearly given in the problem itself. Okay, it will be agreed upon between both the parties, and that amount will be very clearly mentioned in the agreement itself. So it will be given in the problem. When you work out a problem, it will be given in the problem very clearly. So you need not do any calculation. What is given in the problem, you will take, because that is what is the amount which is already agreed upon. So this way of calculating purchase consideration is what we called as lump sum method. So let me just show to you what is given as purchase consideration under lump sum method. The purchasing company may agree to pay a lump sum, that is one full amount, okay, lump sum, to whom? To the vendor company, on account of the purchase of its business, on account of the purchase of its business. And this amount may be mentioned in the agreement itself. So it will be clearly mentioned that this amount will be the purchase consideration. In the agreement itself, it will be mentioned. So that is what is the purchase consideration according to the lump sum method. We can have a look at a very simple example here. Just see the example. A purchasing company agreed to take over a business of a selling company for rupees 10 lakhs. Okay, so what is the agreed amount? The agreed amount is 10 lakhs. In this case, how much will be the purchase consideration? the purchase consideration is rupees 10 lakhs. No calculations are needed here. You don't need to do any calculation because the amount is very clearly mentioned already as per the agreement itself. So this is what is the most simple method which we have, that is the lump sum method. So I hope you are clear with the first method now. Now let us proceed with the second method. So what is the second method we have? The second method we have is the net assets method. This net assets method is also known as what? It is also known as the net worth method. Okay. So in this method, the net assets taken over by the purchasing company is regarded as a purchase consideration. So what will be regarded as a purchase consideration? The net assets. See these words. The net assets taken over by the purchasing company, that will be regarded as a purchase consideration as far as this net assets method is concerned. So for calculating the net assets, we have a very simple formula here. So I'll write the formula. Net net assets net assets is equal to agreed value of assets taken over, agreed value of assets, agreed value of assets taken over, taken over, minus agreed value of, minus agreed value of liabilities taken over, agreed value of liabilities taken over. So how to arrive at the net assets? Net assets is equal to agreed value of assets taken over minus agreed value of liabilities taken over. For the purpose of calculating purchase consideration under the net assets method, there are certain important points which are to be considered. Only if you consider these important points, you will be able to calculate the purchase consideration correctly. Okay, so let us see what are these points now, one after the other. Following important points are to be considered while ascertaining the purchase consideration under the net assets method. Point number one. The term assets taken over includes all the assets of the transferor company. What do you mean by the transferor company? The vendor company or the selling company. All the assets of the transferor company, including including cash, including cash and bank balances also. So when you say assets taken over, the assets taken over will include all the assets including cash and bank balances. So it is regarded that that is also taken over. Okay. But in some exceptional problems, it may be given in the problem itself that the assets taken over did not include cash. So when it is specifically given that assets taken over did not include cash, in such cases alone, you will leave off cash and bank balance. Otherwise, that will also be taken into account. That is point number one. Okay. Now let us see what is point number two. The term all assets, however, does not include certain items. So let us see what are the items which are not included here. The term all assets does not include fictitious assets. It does not include fictitious assets. You will already know what are the various fictitious assets, okay? Does not include fictitious assets like debit balance of profit and loss account, preliminary expenses account, discount, and other expenses on issue of shares and debentures, etc. Okay, so all these fictitious assets should never be taken over. So when you talk about assets taken over, that will not include all these fictitious assets. So if you have these assets mentioned in any problem, you will leave off these assets and take only the remaining. That is the second point which you have to keep in mind. Be very careful, be very attentive, only then you will be able to understand all this clearly. Okay. Now point number three. Any specific asset not taken over, any specific asset not taken over by the transferee company, should be ignored while computing the purchase price. Any specific asset not taken over by the transferee company should be ignored, which means should not be taken into account. What do you mean by ignored? Should not be taken into account while calculating the purchase price. So if it is mentioned in the problem that a particular asset was not taken over, when it is specifically given like that, such an asset should not be considered, it should be ignored while calculating the purchase price. That is what is point number 3. Now let us proceed with point 4. If there is any goodwill, then prepaid expenses, etc., the same are to be included in the assets taken over. So when you say assets taken over will include items like goodwill, prepaid expenses, etc. Okay, unless otherwise stated. Unless otherwise stated. So what do you mean by unless otherwise stated? If it is specifically mentioned in the problem, don't take goodwill, prepaid expenses like that. In such a situation, you will not take them. But if it is not so mentioned, you will take goodwill and prepaid expenses also along with assets realized. Okay, so this is what is point 4. Now let us see what is point 5. The term liabilities includes all amounts due to third parties, that is trade liabilities. So what is the formula I gave you for net assets, calculating net assets? Agreed value of assets taken over minus agreed value of liabilities taken over, isn't it? Till now, I was telling you regarding what are the items to be considered while taking into account the assets. And now let us see what are the items that are to be considered while taking into account the liabilities. Okay. The term liabilities includes all amounts due to third parties. When you say liabilities taken over, it includes all the amounts due to third parties. That is, it includes all the trade liabilities. So, what do you mean by trade liabilities? Trade liabilities are those incurred for the purchase of goods such as trade creditors or bills payable. So all this will be regarded as trade liabilities. So these will be considered as liabilities taken over. Okay. So this is what is point number 5. Now let us have a look at the sixth point. Other liabilities like bank overdraft, tax payable, outstanding expenses, etc., are not a part of trade liabilities. They are not actually trade liabilities, and so they should not be included. That is what is the point we have. Okay. Now let us proceed with point 7. Liabilities for the purpose of calculating purchase consideration do not include. So when we say liabilities taken over, that will not include accumulated or undistributed profits. So liabilities taken over will not include accumulated and undistributed profits like what? Like general reserve, securities premium, workmen's accident fund, insurance fund, capital reserve, dividend equalization fund, etc. So all this will not form a part of liabilities taken over. So I have listed out 7 important points to be considered while calculating purchase consideration as per the net assets method. So you can have a look at the 7 points quickly once again. Okay, now let us proceed with the problem. So I'll work out a very simple problem now to make you understand how to calculate purchase consideration as per the net assets method. Let me read the problem here. Calculate purchase consideration from the following balance sheet. Liabilities you have share capital 3 lakhs, 6% debentures 1 lakh, sundry creditors 50,000, general reserve 35,000, profit and loss account 15,000. On the asset side, you have goodwill 80,000, land and building 1 lakh, plant 70,000, stock 80,000, debtors 60,000, cash 75,000, preliminary expenses 20,000, discount on shares 15,000, and the total of the balance sheet is 5 lakhs. The transferee company takes over the business of the transferor company on the following terms. Transferor company on the following terms. The values placed on the various assets are goodwill rupees 60,000, land and building 1,20,000, 1,20,000, plant 60,000, stock 75,000, debtors 55,000. You are very clearly given in this problem cash not taken over. Okay, cash not taken over. Then you are given creditors to be satisfied at rupees 40,000. So this is what is the problem you have. It's a very, very simple problem. So based on this information provided to us, we are required to calculate the purchase consideration as per the net assets method. So why do you apply net assets method here? Because we are not given any information regarding the mode of payment and other things. You are just given information available regarding the assets and liabilities of the company only. So net assets method only will be more suitable for this particular problem to calculate the purchase consideration. So let us proceed with the calculation of the purchase consideration now. So as per this net assets method, we have to arrive at the net assets first, isn't it? So what is the formula for net assets? Net assets is equal to agreed value of assets taken over minus agreed value of liabilities taken over. So first let us find out how much is the agreed value of assets taken over. Remember, assets will have to be taken over only at their agreed values and not at the book values. So we have a list of agreed values given for the various assets. So let us just write calculation of purchase consideration. Under that, assets taken over. So we have the agreed values already available. The values placed on the various assets are, you are given a list, isn't it? Those values only we are going to take. So first we have goodwill 60,000. So under assets taken over, first enter goodwill 60,000. Then you have land and buildings 1,20,000. Then plant 60,000. Then stock 75,000. Then debtors 55,000. See the problem, all of you. So you are given goodwill 60,000, land and building 1,20,000. Then you are given plant 60,000, stock 75,000, and then debtor 55,000. As per the balance sheet, you just have a look at the balance sheet now. As per the balance sheet, other than these items, you have preliminary expenses and discount on shares. I already told you such items should not be taken into account. Items like preliminary expenses and discount on shares should not be taken into account while you consider the assets taken over. But I told you, you will be taking cash generally, but when it is specifically given in the problem, cash is not taken over, then you'll have to leave cash. So, in this particular problem, you are having a specific sentence here, cash not taken over. That is the reason why we are not considering cash here. So, you can leave off cash, take the rest of the assets, and now let us find out the total of the assets taken over. Having entered all the assets at their agreed values, let us find out what is the total of assets taken over. So we'll just find out the total here. 0, 0, 0, 0 again, 7, 3. 3,70,000. So this is what is the total of assets taken over. From this, we will have to deduct the liabilities taken over. So when we say liabilities taken over, we'll have to deduct only the trade liabilities. And as far as this particular problem is concerned, have a look at the problem. Just when we have a look at the problem, when we say trade liabilities, what is the item we are having here? We have sundry creditors, and this sundry creditors will have to be taken at the values placed at that is at the agreed values. So you are given in the problem creditors to be satisfied at what amount? At 40,000. So that 40,000 only will be taking now. So trade liabilities, that is creditors 40,000. So from 3,70,000, deduct 40,000. So you will be having 3 lakhs and 30,000. This will be the purchase consideration as per the net assets method. So I hope you are able to understand this answer for a very simple problem which we worked out now. So today I have told you about the meaning of amalgamation, absorption and external reconstruction, and we have seen about the first two methods of calculating purchase consideration, that is the lump sum method and the net assets method. In my next video, I will be explaining about the remaining two methods of calculating purchase consideration, that is net payment method and intrinsic value method. If you like this video, subscribe to my channel. Thank you very much for watching this video.